Welcome to the first in a new series of weekly shows focusing on the key macro trends affecting FX and the broader market. Now, please remember that none of this is investment advice. It's for education and engagement purposes only. When investing, understand your own risk tolerance, time horizon, and investment objectives. And then, invest accordingly. This week, we'll look at the factors influencing the recent market uncertainty and whether these will disappear before year end. And let's face it, if you've been invested in the more volatile end of the market, you've probably noticed that the last few weeks have been quite tricky. Bitcoin has had one of its 30% pullbacks, whilst Meta, the Mag 7 stalwart, has lost about 20% of its value. But despite this uncertainty, the S&P 500 is still within a whisker of its all-time high, although it's also been testing its own 6-month uptrend. Investors have been getting nervous, with many gauges of sentiment registering extreme fear. So what are the current issues? Will they persist into year-end, or will conditions ease enough for a rally to take hold? Well, let's start with the broad-based dollar index, which has rallied back to the big 100 level in recent weeks. Now, a strengthening dollar is usually a sign of tighter liquidity, which is normally bad for risk assets. And this recent strength has actually reversed a 12-month trend, because since Trump's inauguration, the dollar had been much weaker, in part due to the uncertainty surrounding tariffs and trade. But this period was generally good for other risk assets, such as commodities and emerging markets. In fact, the emerging market equity index outperformed the S&P 500 after almost a decade of underperformance. It therefore follows that we'd need to see a softer US dollar to get outperformance from emerging markets. But is that really on the cards? Recently, the dollar has benefited from the US government shutdown. That shutdown created a shortage of the dollars needed to keep the financial system lubricated and working efficiently. And you've probably heard this being referred to as a problem with the financial plumbing. This is where there are dollars in the system, but not everyone can easily access them. And during the shutdown, dollars started to build up in the Treasury General Account. This cash, which should have been paying government salaries, was now being held back from the economy. And with fewer dollars available, it meant the cost of accessing dollars increased, and hence that relative scarcity. And this showed up in the areas of the market that are most sensitive to liquidity and leverage, such as tech stocks and crypto. Fortunately, US policymakers have been calling out the plumbers. The New York Fed has already had some crisis meetings with key market participants. And they've also got many previous experiences to also fall back on. And it's not in their interest to watch another funding blockage escalate into a major financial event. But that's not the only thing that policymakers have to contend with. The US economy has also been unconvincing recently. The ISM Manufacturing Index is a relatively cyclical indicator, with clear periods of improving and deteriorating conditions. For much of last year, however, this index has been hovering below the 50 level, and 50 is usually considered to be the threshold between expansion and contraction, suggesting that the US economy has been in a go-slow mode for the last 12 months. And so, the important question is, will policymakers react to either or both the plumbing and the economy? Well, they certainly are looking at the taps on the dollar liquidity pipes. Additionally, the next Federal Reserve meeting, or FOMC, is in early December. Rate cut expectations have fallen from 80% earlier this month to about 50-50 recently. But there's plenty of time for those odds to rise again if the data deteriorates over the next 3 weeks. And the US does not operate in glorious isolation either. Japan's policymakers have already announced their own domestic $110 billion support package. And all of this is part of a global pattern of liquidity provision that supported things like gold's phenomenal run over the last few years, And that's one of the reasons why investors still like to allocate to gold. You see, policymakers have very little to gain by making it hard to get hold of dollars. And if they can keep the DXY around that key 100 level, then investors will be hopeful that the year end will also be bringing gifts.